Good morning, everybody. We are going to start in about 1 to 2 minutes. We want to give a little bit more time for any kind of latecomers who are having an issue trying to get in. So we're going to give them about 2 minutes, and then we will go ahead and start from there. Good morning, Don. I don't know that we had started anything yet, so I'm not sure if you had heard anything. Can you hear me now? Just type in the chat would be fine. Perfect. Okay. All right. Well, good morning, everybody, and welcome to EDP's webinar on the One Big Beautiful Bill Act. It is a tremendous mouthful. It seems like we've been passing a lot of legislations that tend to be tongue twisters. We appreciate your time spending that with us today. We're going to cover the One Big Beautiful Bill Act and what it means to you guys as small business owners in the area of HR, payroll, pensions, those types of things. This morning, we have several EDP staff members with us. Obviously, Sherry's going to be the main presenter. She's one of 3 of our certified HR professionals on staff. We have with us also Melissa, who is the head of our Strategic Growth and Development Department. We have with us Christina Bustos, who's the head of our payroll operations. And then we have Jim, who's with us as well, with the head of the tax department. So we have a lot of information to cover this morning. So just some quick housekeeping items. We are asking that everybody keeps their microphones turned off because we do have a lot of information to cover. There is a Q&A portion. There's a button at the top, should be at the top of your screen. There should say Q&A, or you can put it in chat, type your questions in there. We'll try to answer those as we go along. We will try and get a dedicated time towards the end of the presentation as well that will turn on mics and stuff like that and allow give some good, hopefully back and forth Q&As from there. When we're done with the webinar, we will be sending out a summary of the Q&As to everybody and probably also a copy of the presentation as well. So you guys have that for reference in there. So with all that being said, that's enough for me. I'm going to turn this over to Sherry and let her take this over, and we'll just kind of go down that road. So Sherry, it is all yours.
All right. Thanks, Jeff. I noticed there were a few people said they couldn't hear. So if you want to kind of maybe take a look at that.
Yep.
And I will get started. So, yes, today we're talking about the One Big Beautiful Bill Act. And we're going to talk about what it is and why it's relevant. Included in the One Big Beautiful Bill Act were numerous changes, numerous things were affected. So we're going to just take those line by line, including talking about some payroll changes, some paid family medical leave changes, some FSA changes, HSA changes, 1099 changes, retirement contribution changes, and the Secure 2.0 changes. So, just to get started, One Big Beautiful Act, or sorry, One Big Beautiful Bill Act, we call it OBBBA, or some people call it the OBBBA Act. It was signed into law in July of last year. It affects federal taxes, federal credits, and deductions. When it was signed into law, there were portions of it that were signed in to start retroactively on January 1st of 2025. And then some parts of this bill are expected to expire or end on December 31st of 2028. And then there are other portions of the bill that are supposed to be permanent and will not be expiring. And we'll do our best to kind of lay that out so you know what will be ending and what will not. So let's go ahead and get started about why it's important. Like I said, there are many changes that came along with OBBBA, and a lot of these changes include the above the line deductions for your employees. And above the line deductions basically affect your employees' adjusted gross income. And so the deductions would lower their actual income and it might make them qualify for some other tax benefits, maybe some income-based programs as well. As you know, some of your employees, I'm sure, have already started filing their taxes for 2025, and maybe they're filing some retroactive for their tips or some overtime. The rest of your employees will be doing that soon if they haven't started already. And what they're going to do is just use their information that came on their W-2s in order to go ahead and try to qualify for some of those deductions that started retroactively in January of 2025. For this go round, the IRS said really for employers, they were just more concerned about employers making a good faith attempt on reporting the qualified tips and qualified overtime correctly. So what our focus is today is to really help you understand all the ins and outs of those things and how we're going to look at those going forward, starting in 2026. One thing you want to make sure that you have available, as you know, with these deductions, some of your employees may want to redo their W-4s. And so you're going to want to make copies of those W-4s available. If you don't have the most updated copies, you can go to the EDP website and find those. We could also send those out to you if you need us to, no problem. And the thing that you need to know is that employers cannot tell or instruct their employees how to fill out their W-4s. We also cannot do that. It's illegal for us to do that. And so when people call us, we're just like, we can show you where to find the information, but we can't instruct you on how to do that. And I would caution employers of doing that as well, because it's not something that we're supposed to be able to do for our employees. But if your employees want to know where to look at trying to assign their possible deductions for the next year, that you can instruct them that the deductions that they will be dealing with are on the instructions on the deduction worksheet. And it's going to be number 1A and B on step 4B. And so it's part of it, it's that page 4 of that instruction sheet. It's going to be those first two categories of that question A on page 4 in the step 4. And so you can guide them to that, and it will pretty much walk them through that. It talks about all the qualifications, as far as income, that type of thing. So moving on, we're going to go ahead and talk about the qualified tip employees specifically. So the reporting period, like I said, for the qualified tip employees actually started retroactively back in January of 2025. Some of your folks are probably already trying to take advantage of that by filing their taxes and claiming that now. Um, there are claim amounts they can claim up to $25,000 on the tips for that deduction. There are different qualifications to be able to claim those tips. First of all, those tips have to be given in positions that already usually typically qualified for tips. So if you are in question about that, we can send out a website to you from the IRS that gives a list of those occupations. But basically, if you were in a position or your employees were in a position or a job that received tips prior to December 31st of 2024, they're going to be allowed to apply for this deduction as well. You know, you've got the basic ones we all know, like restaurants and hotels. But there's others as well, like transportation services, whether you're like a Lyft or a taxi driver, personal care services or wellness services like salons and barbers and maybe some massages, home services like housekeeping, lawn mowing, that type of thing. Delivery services also qualify as well as recreation and instructional services. So if you hired an instructor to help you learn a language or maybe help you teach you how to play golf and you would normally tip the person, they would also be included in that, as well as street performers, anybody who's like acting as a valet and like maybe a bathroom attendant at a big event, those type of things. So, with that being said, like I said, we can go out to the IRS. I can send you a link if you're interested in that. But you can find a whole list of those jobs that would qualify. Um, just for starters, tipped employees usually have to make at least $30 per month to be included, and that is as far as qualified tips, and that is the way it's set up for this deduction as well. You need to make at least $30 in tips per month. All tips must still be included on the payroll and reported on the W-2s. If they're not being included or reported, your employees are not going to be able to take advantage of those deductions. And so it's important to still make sure to capture those. Um, what you must know is these are federal deductions only. So it only affects their federal income taxes. Everybody's still got to pay all the rest of the taxes. Employers have always got to pay all of the taxes. But for your employees, it's only going to work for their federal deductions. Um, there is a limit to the amount that qualifies. So if you want, if your employees want to be able to take the deduction, they have to meet, individuals must be less than $150,000 annual salary per year. And then if they're married and filing jointly, they have to have a total income of less than $300,000 per year. So there is a limit to that as well. Couple of things that you need to be aware of. First of all, everything on these qualified tips has to be voluntary, and that's where you typically will pay for service or hospitality-based services. Um, Either those go to your like your waiter or your person directly or into a shared tip pool where employees who do not typically get tips are allowed to participate and share in those tips that are collected, like cooks or hosts or table bussers, those type of things. But it has to be voluntary for sure, because the other one is a mandatory tip or a service charge, and those are not allowed to be used for the tip deduction. Those might be in those situations where you go to a place and it says if you have 6 or more people, then there's an expected gratuity or an expected tip that you have to pay. And those would not be included in this deduction. So they're going to have to be separated out. There also is during the pandemic, there became this different type of charge, maybe a service charge that restaurants were adding on. I think part of it was to help offset employees' tips that they weren't getting because, either the restaurants were closed or they were only allowed to seat so many people at a time. But those became the mandatory service charges, and those are not allowed to be included in that tip deduction either. So those things, they could go for tips, or maybe they could be used to help cover operating costs or insurance for employees, and that's why they're not included in that. So you have to be able to separate those out. Sorry, I'm going to go back one slide. And you have to be able to make sure that you're not including those, but they all still must be included in the payroll and reported on the W-4, or sorry, on the W-2. So even if they're the mandatory charges, they may not qualify for the tip deduction, but you still have to report those, and so will your employees. All right, moving right along, we're going to go ahead and go into our overtime deduction. Again, there's a reporting period. It actually started retroactively as well in January of 2025, and this one is scheduled to end on December 31st in 2028. The deduction still only applies to federal income taxes. Okay, it's not going to apply to any other taxes. And employers are still responsible for paying taxes on the full wage amounts, including tips and overtime. Employers, you're still expected to cover everything that you've always normally covered before. What is important to know about this is that actually it's only a portion of the overtime that is tax-free. And just as an example, when we say overtime, we call it maybe time and a half, right? It's only that half time or that 0.5% of the time that will be included for this deduction. So if someone works 20 and has an hourly rate of $20 an hour and they work over 40 hours, for their time and a half rate, they would be making $30 per hour on that overtime. However, it's only that $10 of that 30 that is going to get the deduction, that's going to qualify. So it's still just that half time or that 0.5 time that is actually going to qualify that they can count. So it's not everything that you make on overtime that is included in that. And that's important to know. They can claim up to 12,500 for an individual or 25,000 if married filing jointly. The overtime also phases out for higher earners. So those people that are individually making $150,000 annually or more, or those married couples that are making more than 300,000 annually would not qualify for the overtime deductions. Even if someone is not going to qualify for the overtime deductions because they're high earners, it still has to be reported, of course, by employers. So all of that still would have to be reported. So you don't want to not report something just because you don't think they'll be able to use it. A couple things to be aware of with this as well, and this is kind of where overtime gets a little sticky since it's federal. Typically, Fair Labor Standards Act puts overtime, anything over 40 hours is considered a week is considered overtime, or if maybe you're in a healthcare field, it's anything that's over 80 hours in a 14-day period. However, this is where it gets sticky because some states have other different overtime laws that you need to be aware of. For example, Colorado, California, Alaska, and Nevada all have different times where that overtime kicks in, and it's not over 40. In fact, in Colorado, if you work more than 12 hours a day, you are qualified to receive a time and a half for overtime. In California, if you work more than 8 hours a day, you are able to get overtime. And then, of course, if you work more than 12 hours a day in California, then you get double time. So your state may have different laws on who qualifies time-wise on overtime. And it gets a little sticky because this deduction only applies to federals. So if you're paying overtime for your state law, all of that overtime may not qualify for this federal deduction. And so what you're going to need to do is somehow separate those out as far as what would qualify over that 40 hours and what doesn't qualify, so that your employees will know which ones they can utilize and which ones they cannot. Okay. So it's important. Also, there are some exemptions in state overtime laws. For example, nonprofits in federal laws still have to pay overtime, but there are states like California where nonprofits are exempt from overtime. So it's very important to know your actual state laws. Another thing that you need to be aware of is for the deduction on your federal income for overtime, it only applies to actual hours worked. And I know that a lot of folks, that's how your time is set up. That's how you go by. But I do know that we have some clients that they will actually still calculate in like any PTO, sick leave, holiday hours. They'll calculate all those in as well. So maybe they're paying overtime with those hours included. For this deduction, they're not going to be able to include those hours. Only actual hours worked are allowed to be included in this deduction. So if that's something that maybe your company allows those hours to be counted towards overtime, you may want to take a look at that, or you may have to do some separating as well for your employees to have a good handle on what would qualify them and what would not. And lastly, one thing that you want to make sure that you're paying attention to is your exempt versus non-exempt status. And exempt means you're exempt from overtime. Obviously, non-exempt is you're not exempt from paying overtime. But what I run into quite a bit is a company who may say, I don't want to have to pay overtime, so I'm going to just put them on salary. And the idea that they don't understand is they think that salary automatically means exempt, and that's not the case. There are different exempt statuses for executives, administratives, exemptions, professional exemptions, outside sales exemptions, etc. But there are qualifications for those. And so you can't just willy-nilly say, oh, I want to pay somebody a salary, and that way I don't have to worry about paying overtime. You actually have to make sure that they are qualified for that exemption, or it could get you into a lot of hot water if you owe a lot more money for not paying them overtime. There is obviously stuff out there that you can look at on the Department of Labor website about overtime and who qualifies. But if you have any questions about that, please feel free to reach out to us. We can help you look through that information as well and try to decide if your employees qualify for that or not. But it is something I do want to caution you to be aware of. All right, so next we're going to go ahead and move into the paid family medical leave. This has changed just slightly. This has been around since 2017 as far as having this type of deduction. It was part of the Tax Cuts and Job Acts, but now this is something that is going to be permanent. It is not expiring at the end of December in 2028. It's going to be around permanently. There are some changes, however. First of all, an employer, if he or she is going to offer paid family and medical leave, they have to have a specifically written policy in place that explains exactly how that's going to work. The length of employment can change as well. So instead of having to work that full 12 months, they can actually work 6 months and be eligible for that deduction, or employers can have them work 6 months to be eligible for that deductions, and employees can take those that paid family medical leave after 6 months of employment. Usually the paid family medical leave would be for full-time employees, but the changes that occurred allows it also to be available for part-time employees who work at least 20 hours a week. Um, it would be prorated, of course, so they're not going to get the pay that they would get if they were a full-time employee, but it's going to be comparable because it'll be prorated. Companies that are offering this have to provide at least 2 weeks of paid leave annually. So they have to be able to, if you want to have the paid family medical leave, you can't just decide, okay, well, I only want to offer 1 week of that. You have to at least offer somebody 2 weeks of that in order to qualify for that tax break. And then the employee themselves has to earn at below $96,000 annually, or they're not allowed to have that paid family medical leave. And so those will be like your high wage earners are not necessarily going to qualify. And then when you as an employer pay for the paid family medical leave, the wages must be at least 50% of their normal wages. So you can't just give them 40% and say, yes, I'm paying them, I should get this deduction. You have to provide at least 50% of their normal wages in order to qualify. Now, the difference also is that employers now get to choose how they want to calculate the credit for the deduction, and they have a couple of different options of being able to do that. Either they can take a percentage of what they pay the employees while they're on leave, or they can calculate it as a percentage of the insurance premiums they pay for covering that paid family medical leave. So they get to choose, and that's kind of a nice freedom for employers to have to figure out what's going to work best for them. Now, the base credit for this deduction is 12.5%. And basically, that 12.5 actually increases quarter of a percent for every percentage point the employer pays above 50% of wages. So if you want to pay them more than 50%, you're actually going to be qualifying for a higher deduction credit. Now, it does max out at 25%, so you're not going to make any more than 25% for that credit, but you can get more than just that straight 12.5. There were some contribution changes for your dependent care flexible spending account, your FSAs. This was the first increase in 40 years. So that was kind of a big deal. Of course, this is pre-tax. This helps pay for child care and care for dependents. The child care goes up to age 13. Anything after that, it does not qualify. And then the dependent care is a lot of times like that elder care or somebody that some type of care that might keep you from being able to work. And so that's, I think, a big portion of what we would consider typical elder care. It is a permanent increase. It will not go away in December of 2028 at all. And the new contribution limit went up from 5,000 to 7,500 starting in 2026. So that's quite a jump there. And for married who file separately, the limit went up from 2,500 to 3,750. So there was a huge increase in that, in those contribution limits. So that's nice to have. Then there were some changes in the health savings account. There were some changes in the telehealth and remote care services. Basically, now you have the ability to receive telehealth and other remote care services before you have to meet your high deductible health plan. and it still allows you to contribute to your HSA. It's not taking away your ability to go ahead and continue to contribute to that. So that is quite a change. Um, there was a change also on the marketplace. I'm sorry, the exchange on the high deductible healthcare. Those bronze and catastrophic healthcare plans are now being treated as high deductible plans, which again allows plan holders to contribute to their HSAs. Even though they're high deductible, it gives them an opportunity to go ahead and do that. And then there were some changes in the direct primary care service arrangements. And basically, that's when you're able to use your HSA funds to pay for certain direct primary care services, such as like routine exams, immunization, health screenings, annual exams, eye exams, dental cleanings. Now, what I will tell you is that this part of the OBBBA is, and these HSA changes are not quite settled yet. The U.S. Treasury and the IRS are still working on the specifics of these, and they're actually inviting comments on them until March 1st. So basically, I would expect something to roll out maybe by the end of March if there's going to be changes, and they're going to be able to tell you more about those changes that came about for that. There were changes in the 1099 reporting threshold as well. We went from $600 to $2,000 per payee, so that was that's quite a change in order to do those. So just be aware of that. As part of this, and this is one of those things that's not going to expire at the end of December of 2028, but it's actually expected to have inflation index adjustments starting in 2027 and then annually thereafter. So it's going to continue to change each year. So just be aware of that. And the effects are going to be on the 1099 contractor payments for those independent contractors, the NEC, and the certain non-wage payments that form 1099 miscellaneous. If you have questions on those, just let us know. We're happy to help with those as well. And then lastly, one of our biggest categories that we're going to be talking about today is the OBBBA and the Secure 2.0 Act. Or yes, 2.0 Act. First of all, there's new limits for your 401ks, your 403bs, and your 457b plans. And basically, we see an increase in 2026 of the contribution being, it was 23.5 and now it's 24.5. So it's come up $1,000 for that. As part of the Secure 2.0 Act, we also have updated limit contributions as well. So if you are age 50 to 59, your catch-up can be $8,000 starting in 2026. That would give you a whole total contribution of 32.5. If you're age 60 to 63, we're doing what they call a super catch-up. And so that super catch-up is going to be $11,250 for 2026. And so that would be a total contribution of $35,750. And then at age 64, it actually reverts back to the catch-up that we are allowed at age 50 to 59, which is going to be that $8,000. So that super catch-up is pretty big, and it's just between ages 60 and 63, but that's where you're going to get most, I guess, bang for your buck there. So there were also updates in the contribution amounts for your IRA accounts, and it went up from 7,500 to 8,600 for those that are over 50 years old. There was an updated 2026 deferred contribution as well. So high income earners, and those are with those FICA wages that are over $150,000 in 2025, those folks must make their catch up as a Roth contribution in 2026. So instead of having a pre-tax and doing the catch up in pre-tax mode, they're going to have to do it in a Roth, which is the after-tax mode. So they're going to have to pay on the front end rather than on the back end of that. And then for simple, it's the same, but it's a little bit different. There were different amounts. So the contribution limit increased to $17,000 for 2026. And then it followed along the lines of everything else with your 401ks. It has the updated catch-up limits. Age 50 to 59, the catch-up limit is 4,000. On 60 to 63, again, you have that super catch-up contribution, which is 5250. And then age 64, it's going to go ahead and revert back again to that 4,000 for that catch-up. The interesting thing here is there are higher limits for companies that have fewer than 25 employees. So your contribution can be much higher if you're part of a small business that has less than 25 employees. So the standard contribution for those folks is going to be 18,100, and the catch up for them is between ages 50 and 59 is 3850. That super catch up is a little higher for 60 to 63-year-olds, which is 5250. And then as per the rest of them, age 64, it's going to revert back and have the same catch up as the 50 to 59 age groups. So we just kind of tell you, if you have questions, like specific questions about your plan and your contribution limits around the Secure 2.0, we would encourage you. I mean, you can definitely talk to us, but you also might want to reach out to your plan administrators or your benefit brokers and get more detailed information about that. So to kind of sum up, what do employers need to do? Well, first of all, you may want to update your handbooks, especially when it talks about the overtime and the tipped employees, how those things are handled so that your employees have an up-to-date information on what they can expect on being able to claim that deduction. You may want to go ahead and double check your employee classification for exempt and non-exempt status as well. Again, you don't want to be wrong about those things. You want to make sure that your tips and overtime are reported separately on your employee pay stubs. And again, I would caution those folks, especially on the overtime. If your state laws are different than the federal law, you're going to need to probably further separate that overtime that's reported so that your employees know which portion of it they can get from their federal income deduction and which portions they're not going to be able to qualify for. You may want to consider consider timekeeping system for tracking. Of course, if you're interested in any of that, especially for the overtime stuff, you can talk to us. We've got a couple of things that we can talk to you about as far as iSolve timekeeping or swipe clock timekeeping. You also may want to educate your employee on the tip and overtime credits. One thing to note, if your employees are in that lower income tax bracket, this may not be a huge benefit to them because they may already owe very low or no federal taxes whatsoever. So the deductions may not help them much. You also need to make sure that they understand that to qualify for the tip and overtime deductions, they have to have a valid Social Security number. So if they are residents, maybe they're permanent residents, but they don't have a Social Security number, they may not qualify for those. You have to have a valid Social Security number. So that would be something that if there was a concern about it, they would probably need to talk to a tax professional. The other thing would be to worry about the filing status with the tip and overtime credits specifically. If you are married, you must file as married filing jointly in order to receive those deductions and those credits. You cannot do married filing separately unless you might be in a situation where there's some domestic violence issues or some spousal abandonment issues. Those may qualify as exemptions from having to file married jointly. But again, we would encourage you to talk to your tax professional on that, just to make sure that you could prove that, or what you needed to do in order to still claim that. Again, we want you to know that inaccurate reporting on overtime and tips, it could trigger IRS penalties. It could trigger Department of Labor audits. So you want to be very careful. Like they said in 2025, it was good faith reporting. 2026, they're probably going to be more stringent on making sure that everything is matching up. So we want to get this right out the starting gate, and allow your employees to be able to know exactly what they're having to claim in order to get those deductions. And so with that being said, I think I'm going to pass it back to Jeff for questions. There you
Perfect.
are.
Yeah, there I am. Here I am.
You
Always
are.
in the background. Okay, so great information. Appreciate all that. I do have some questions, and then we'll open it up for everybody else if they have other questions to ask as well from there. But there were a couple that came in through the chat and through the Q&A portion of it. Okay, first thing was Kelly had asked about they pay overtime on all Saturday hours, and in most cases they don't work 40 hours. How does that apply for the overtime rule? My initial thought was if it's classified as overtime, it's going to be that's going to be looked at in the system as counted towards the calculation if you're reporting it as overtime, as long as it's actual hours worked. So please feel free to trump that. I'm okay with that. If anybody wants to weigh in on that, Melissa, Christina, Sherry.
Jeff, I'll take that one if it's okay.
Okay, absolutely.
Kelly, what I would recommend is that you don't change how you're paying your employees. Let's change what we're calling how we're paying our employees. So let's take it out of that overtime status and put it in as like a Saturday worked, still paying it at that time and a half and still calculating into the 40 hours worked for the week, but actually paying them at time and a half. If we keep them listed as that overtime, then it's going to try to give them that tax credit at the end of the year, which could at some point raise some flags, which we don't want to. So that's why I recommend let's just switch it over to being a Saturday worked paid item instead of an overtime paid item. Does that help a little bit, hopefully?
Christina, anything else you want to add in on that?
I would say yes, whatever, for what Melissa said, because truly it is 40 hours worked per week. So anything over the 40 hours that goes into overtime would be that premium, not anything that you are, like, for example, Kelly said Saturday overtime. You're just paying them time and a half for working on a Saturday. It wouldn't actually be considered in the premium unless it was actually 40 hours worked, past 40 hours worked in that work week.
And this is why I bring the experts. Yay. Okay. Kelly, does that help? It looks like that made sense for you. Okay. Tammy had a question on the FLSA. And I think it had to do with how it applies. If the medical leave is paid through short-term disability policy, then it would not apply to those benefits from the, I guess, the FEMLA. Sure, I think that's probably more your area. You're muted, by the way.
I do know that.
Yeah.
I'm not exactly sure how that would play out. That may be something I need to get back to you on.
Okay. We will get an answer for you then on that one, Tammy, just to clarify that for you.
That.
Yeah, we want to make sure we get you the right information instead of just kind of what we think maybe. We had one of the other questions, and this kind of goes back to something that we have noticed as well. It's from Heather, the update on, and this gets into that overtime, FLSA overtime premium. If you're a biweekly payroll or your semi-monthly, weekly payroll, and overtime is calculated on the 40-hour work week, but we turn payroll in pay periods. We don't turn them in by the week. How is the system handling that? And if we're having issues with that, understanding what that overtime calculation is, now based on a biweekly, is the system going to be able to retroactively fix that for us if there's some sort of update or something else that's going to happen that's going to allow the system to calculate that correctly? Because right now it doesn't look like it is. So do we have any kind of guidance, updates, information on that? Does that make sense, or did I totally butcher that question for you guys? Anybody? Melissa, Christina, Sherry?
So if I understand the question, it's the overtime being calculated by the pay period, not by the work week.
Yes.
Okay.
Yeah, if they work 50 hours in 1 week and 30 hours in the next week, the total in the hours are still only 30 or 80 in the pay period, but you have 1 week that has 10 hours of overtime in it. And how is that? It doesn't look like it's showing correctly in the system, where it's calculating correctly in the system on the overtime, because you do have overtime, but it's not saying that.
So I would recommend a few things. If you're using a timekeeping system, check some of the settings on that timekeeping system to make sure it's calculating based on a work week, not a pay period. If you can set the settings like that, then it will calculate correctly based on the Fair Labor Standard Act requirements for your overtime. If that's not a possibility, then maybe we should talk a little bit more together and kind of work through how that would look and what that would look like for you.
Okay. Christina? Anything?
Nope, exactly what Melissa said.
Okay, perfect. All right. Kelly, you guys, I've turned on the ability for you guys to unmute your mics as well, so now you can chime in. But Kelly, you may need a little more clarification on your question about back on the FEMLA. It's not required to offer paid FMLA. This would be just if you did offer it, correct?
Yeah, what I mean by that, Jeff, is we don't offer paid FMLA leave.
Okay.
And we're not required to do so.
Right.
Correct?
Right.
This would be back to the FMLA part of the presentation. This would be only if we did offer it, would the new regulations affect us
Okay.
as a company, as an employer for the credits.
Sure.
Correct?
Can my expert weigh in?
Yeah, sorry. Yeah, because it's not required. And I think you were talking about were you talking about that short-term disability?
No, I think that was
Sorry.
someone else.
Oh, that may have been somebody else. Oh,
Yeah,
okay.
that was.
Yeah,
that was
you don't have to offer this, the paid, FMLA, but for the credit, those were the qualifications. I think I missed your question. I'm sorry. What
That's
is
okay.
your specific question?
My specific question is, we don't have to offer it, correct? We
No,
don't have to offer pay.
absolutely not. No.
Okay.
It is only if your business wants to get that credit deduction
Perfect.
for their
That-
taxes.
That
You're
answers my
good.
question.
Yeah, okay,
answers.
sorry.
Thanks, Sherry.
I was confusing the two, putting them together.
No
I didn't
worries.
have-
I kind of threw that in there on top of my other stuff.
Okay.
Okay, let's jump back to Heather's question about the overtime calculation, overtime premium, and our comment. And Heather, feel free to chime in. You have the ability to unmute your mic. So if you want to ask that question, maybe more.
Yeah, maybe that would be easier. I'm sorry
Yeah.
to
No,
bring
you're
it
good.
back. My concern
Okay.
is, I know I'm confident that we're paying out the overtime correctly. And in the example I gave, an employee works 10 hours of overtime 1 week and then 30 hours the next week. And so we're paying them the 10 hours of overtime. But in iSolve, there's a new memo calculation where it's calculating that overtime premium for W-2 purposes, where since that employee worked a total of 80 hours, it's saying that there's no overtime premium calculated when we did that employee worked and was paid for 10 hours of overtime. And so I was just curious if you had any updates on those calculations. And when we get that fixed, will that be a retroactive fix for hours already paid?
Heather, was that from 2025 or 2026?
The memo calculation started in 2026, and I've just been told that they're working on it, but I'm just concerned that it might be hard to fix retroactively.
Okay, we might need to look at that together and kind of let me know. We can talk about which employees you're looking at and say in that.
Okay,
Yeah, that may
Yeah.
be specific to you
that
guys.
sounds good.
That we
I,
need to
I
take
think
a
it
look
is.
at.
Sorry.
Thank you.
Good question, though. Glad you brought it up. So we need to hear. Okay. Okay. So I have a couple of questions for you guys, our panel of experts. Going forward into 2026, what do our small business owners need to understand about how they need to report overtime going forward on payroll every time they turn in payroll? What do they need to be aware of? What questions should they ask, not ask? What advice, what guidance would we give them?
I think,
Christina, that's you.
oh,
Yeah.
sorry, go ahead.
Yeah, and I'm sorry, I'm reading a question that Shara's had. If our pay periods are biweekly, but we pay overtime based on 40 hours worked per week, do we need to separate the weekly overtime, or is it okay just to report the overtime as a lump sum? Shara, as long as you're basing it on 40 hours per week overtime, then the way that you're doing it as a lump sum does suffice. So yes, you're doing it the correct way, as long as you're doing it based on 40 hours worked per week. So sorry, Jeff,
That's okay. I got you.
because I was reading the question.
I was trying to find your question. I was like, I saw that it was there, but I couldn't find it. So I'm glad you found it. So
I think
good.
on the question, it was about like looking forward and how do we turn our overtime in, that type of thing. And I would kind of echo what Melissa said, if it's, again, you're going to want to separate those if state law is different than federal law, because the deduction will only apply to the federal income tax. And so Melissa said something about, I know, like when we were talking with Kelly about giving it a different name, you can still pay those, but somehow want to separate those on your payroll. And I'm not sure exactly what that looks like, but Christina might know more about that. But you would definitely want to make sure that you're only capturing the right amount of federal, that would apply for the federal deduction. You have to report all of it, but you're going to want to separate those out.
Do they need to do anything as far as we talked about? It has to be hours worked. So if they have a policy that says, listen, a holiday, vacation, sick time, all that counts towards them getting overtime pay. How do they need to turn that information into us on a regular basis? If that's what their policy is, but we know that doesn't apply for their overtime credit, how do we suggest that they handle that?
So how I would suggest that they handle it is that if you are going to use, say, whatever personal time policy that you have, whether it be vacation, sick, PTO, and you let them claim overtime, with that being over 40, that we make another code for you. So it will record if you actually have over 40 hours worked to be in that premium, instead of it just being the overtime. So there would be a change in the way that you needed to turn in the overtime hours worked.
Okay. All right. If anybody is interested in knowing more about the timekeeping solutions, because that's really the easiest way and the best way and the most efficient way to handle this for them and to kind of give them that peace of mind. Melissa, they need to get a hold of you. Is that the
Yes, please.
best place for them to go is to talk with you about what those options look like?
That is
for
correct.
them? Okay, perfect. Thank you. Okay, so let's talk about tips real quick. We got about 6 minutes left. Going forward again, what's our best practice suggestion for employers who have tipped employees, and how they need to turn those in based on voluntary tips versus the service or the mandatory tips, and what needs to be their method moving forward on how we're going to expect to see those coming in on payroll so that everything's reported correctly.
Coming in on payroll, they will, as a company, if you don't offer tips, you will want to break that out, what tips are voluntary and which tips are non-voluntary. So your CSR can report them correctly within your payroll.
Will that be reflected on, like, I know some older clients, we have input worksheets, or they, have other formats that we've given them on how to turn their payroll in. Are those two different essentially earnings codes? Those are going to be reflected on, like if they have an e-sheet or an input worksheet, are those going to be now reflected on those when they, if we give them a new
Yes, that will
copy?
be another line item.
Okay.
So you'll have voluntary tips and non-voluntary
Okay.
tips.
And if they just email in their hours or what have you, they're just going to need to specify in that document or in that email that this is mandatory and this is voluntary.
Correct.
So that we can code it correctly. Okay. Perfect. Okay. Yes, Kelly, absolutely. No, ask your question about overtime. Let's take care of that now while we can.
Okay, so I have a question. I don't know if I'm gonna say it right. So if I'm looking at an employee and they have 2.78 hours of overtime, for the time and a half, the half is the only part that is, that qualifies. If I'm looking at their paycheck, their pay stub, I don't see that broken out differently. Or am I missing something?
No, you're not missing anything, but I'll let Melissa and Christina address that one, but you're not missing anything, so you're safe there.
Kelly, right now we have everything calculating behind the scenes for you and your staff. So at the
Okay.
end of the year on their W-2s, the W-2 in box 14 will reflect that correct portion of the overtime earnings that are eligible for that tax reduction.
Wonderful. Thank you. That's all I needed.
Yep. And there are reports also in ISOLT and for the clients who are still on Evolution, there are reports available that will show you that'll show you all your employees and what the premium is for your
okay.
employees. So if you want to run those, you can run those on your own as well. We're exploring options as to having it show on pay stubs, and is that an availability? Is that something we can enable, those type of things, so employees can see it as well. And so we're kind of looking at some options there for you guys also.
Oh, okay.
Yeah, great question.
Thank you.
I'm glad you asked that. Glad you asked that question. Okay. On the Secure 2.0 Act, those are the increase in the limits, those types of things. Those are handled automatically in the system. We set those at the beginning of the year, correct? Melissa, Christina, we set those new standards, those new limits there. So it's automatically taken into account for the new limits. And that's been pretty much a standard. The question I have is for these guys, is for the high wage earners, because it has to be turned into a Roth. The contribution has to be done. So Roth, that's not something that automatically happens, or is it in the system, or is that something that needs to be set up with their administrators, and then we're notified, and then we set up that Roth for them on payroll? How does that need to be handled?
Christina?
So if you're a high wage earner and you made over 150,000 last year, then it will have to be a Roth contribution, which then, to my understanding, you would have to make sure that you have that set up with your provider, your 401k provider.
So yeah, so once they set that up, then notify us. We'll set up in the payroll side of things for the Roth contributions to happen automatically
Correct.
on that. Okay, perfect. Okay. Anybody else have any other questions? Yeah.
Hey, Jeff,
Jim.
just a note
Got
on
yours
that,
in
on
mind.
that Roth. If they do not have a Roth set up, then the high earners cannot take that additional deduction then.
Okay.
They have to have that set
Have
up
to have that
by
set
the
up.
plan. Yes.
Okay. Perfect. Okay. So you said Jim actually does live. I forgot he was there. He's so quiet in the background. Any other questions for Jim in the tax department? Because he's questioning why he was here, I'm sure, because he hasn't had any questions sent his way. Then
I
just
do have
just lob a
one
question at
for
him.
Jim.
Yes, please.
So in regards to the paid family leave act, I wasn't aware of the tax benefits of that previous to this meeting today. Jim, can you just dive in a little bit? When they say the 12.5%, what 12.5% of what? I apologize if that's a silly question, but the 12.5 to 25%, what exactly is that calculating?
I might have to have Sherry join me on that one, but I think that's just the 12.5% is the amount of the wages that you're able to deduct, or you are contributing to the plan. And then that amount is what you will be able to write off then, is the amount that you contribute to that employee's plan then.
Yeah.
Okay, sorry, go ahead.
No, I was gonna say, because employers are allowed to calculate it how they want to now, it could be that percentage of what you're paying your employees when they're out on leave, or it could be the percentage of the premiums that you pay that covers them. But that's that 12.5% deduction based on that, from my
Okay, so
understanding.
So then
Yeah.
it would be 12.5 to 25% of what you pay them on leave, or the other one is what's tax deductible. Or
What your
considered
premium, what you're paying for their premiums to
premium.
cover that. Yeah.
Okay,
Thank
thank you for clarifying.
No problem. To get those higher percentage for deductions, you just have to pay them more than that 50%. So if you wanted to pay them 60%, you're gonna get more than that 12.5. It's just that the max would be that 25%.
Okay, thank you.
Uh-huh.
Excellent. Okay. Any other questions? Because we're kind of bumping up on time here. We want to make sure we're trying to stay true to that hour. Any other questions for our staff? No? Okay. I would offer one other suggestion for you guys, for all of our clients. When Sherry had mentioned in the presentation about changes to your handbook as you're updating different policies and things like that. For clients that we have migrated into the iSolved platform, and as we move the rest of everybody into the platform, in 2026, we do have the ability through the employee self-service portal to be able to post these policies, handbooks, updates, all that stuff in the portal for employees to be able to access through the portal. If that's something that you want them to be able to do. There's all kinds of functionality in there that you can require them to electronically acknowledge that they've seen it, they signed off on it. They can send out reminders until they do it. All of those great things are available in the platform if you guys have not taken advantage of that. If you're curious about that, please get a hold of Melissa and her email address if you don't have it already, which probably most everybody should, because she is probably one of the people you hear from most. It's just melissa@columbiaedp.com. It's a great way to make your life less complicated. We can show you how to do it, or we can upload those things for you and implement that process for you, so that your employees are going out to their portal where they go and get their pay stubs. They can also now see their handbooks and policy updates and stuff like that for you guys. So there's a lot more functionality there. So please get a hold of her if you have questions about that. But and kind of to wrap this whole thing up, we will be sending out a copy of the presentation to everybody who attended. We'll be sending out a cleaned up version of the Q&As as well to everybody. And then we've also recorded it. So we'll provide a link, but the link has a lifetime on it. So Once we send that out, you'll want to be able to download that as soon as you get it so that you can have it for future reference if you need it from there. That'll have all this information in there for you guys. So with that being said, we appreciate your time. We know you guys are busy, taking time out of your day for us. We understand that. We're grateful for that. But again, reach out to us if you have any other questions after that. But that's pretty much where we're at for today. Again, thanks everybody.
Thanks, everybody.
Take care.